Sanjeev Prasad, good morning. Are you ready? Hello, I can see him. Good morning. How you been? Long time.
Yeah, all good, all good, all good. I didn't hear you properly the first time. Yeah, all good. Yeah, no complaints.
Well, everybody's complained about tariff now. No one's left to complain only.
I know. What can one do about it?
Are you
Grin
still
and bear it.
complaining about high valuations, or Sanjeev Prasad has officially stopped complaining about high valuations after the fall?
So what after the fall? The market is pretty similar to where it was on April 2nd, right? So despite all the confusion, volatility, etc., the market is back to similar levels as if, the tariff saga is already over. All the concerns in the bond market are behind us. So yeah, so the market has its own moods. We have taken a call that all the problems in the world have been resolved. So let's see. But on a more serious note, valuations are high, and I don't think there is any dispute about that. Uh, Pretty much across the market, barring the BFSI sector, which we have been maybe highlighting for the last year or so. Valuations have been on the higher side. They stay on the higher side. So yeah, I don't think anybody will come and say the market is cheap, right? If you have consumer names trading at anywhere around 50p for the kind of growth they're delivering, low single digit, mid single digit at most. I mean, what sense does it make? You have capital good companies, most of them north of 50p again, IT companies all north of 20p with very little growth to show for now. So where is the dispute about valuations being high?
So Sanjeev, while today we are getting excited for right reasons, markets are up. Gains have erased, losses have been erased. But do you think somewhere we need to just be more realistic that the impact of tariff, both in terms of sentiment, trade, and also supply chain, is something which is far lasting? And it's a matter of time. Corporates will come out and say, okay, we are suffering with order cancellation or inventory pile up, or perhaps lack of visibility. Do you think it's a matter of time that those concerns, which today we are not talking about it, will start haunting us?
There are several things out here, right? You still have 3 months to go, where you will possibly have a lot of volatility in terms of what trade deals ultimately get negotiated. The best case scenario is, if you go back to where we were before this whole tariff saga started. But I don't think the world is going there, right? The US administration is very clear on three objectives, I will assume. One is, of course, reduction in trade deficit between the US and other countries. Number two is reindustrialization, reshoring, call it whatever. And number three is to some extent a weaker dollar. So you can't make an assumption the world is same as it was a month or 2 months back. In the interim, you will have a lot of uncertainty. I suspect respect to news flow on what concessions are given by various countries in terms of opening, their countries to imports from the US. What other concessions are coming beyond, just trade part. So a lot of things are on the table as of now. On top of that, given all the uncertainty, households will be, somewhat more reluctant to consume. And even before this whole tariff saga started, you look at the US household confidence index, it had anyway, come off pretty sharply. Companies will struggle to invest in this kind of environment, and a lot of decisions will get postponed, right? And who wants to take decisions on capex when the immediate focus is on the next order, which is going to come from Vietnam? What do you do with it, right? Supply chains don't move that easily. So I think you're going to see a period of slow growth for sure. Whatever was your base case, let's say growth for global GDP before this tariff saga started, assume you chop it off by 1%. The IMF is projecting about low 3% growth for global GDP growth for 2025. I assume it's down to 2. Thankfully, the worst case situation, of massive tariff retaliation, big recession, thankfully for now seem to be off the table. As far as India is concerned, you probably knock off 0.5% from the GDP dynamics for now. If you're already looking at 6.5, you brought it down to 6, and from there we will see. So all said and done, the situation is worse than where we were a month back. So that's a limited point I will make, and a lot more uncertain. So in that case, any investor should be logically building in, somewhat higher cost of capital, cost of equity, whichever way you want to look at it, or asking for higher yields just to offset the higher amount of uncertainty or risk out there. So the world is no longer the same as it was a month back. That is for sure.
All right. Hi, Sanjeev. Good morning. This is Shrishti also joining in. But Sanjeev, yes, indeed, it is a developing situation. Every day we get to hear a new announcement on the tariff and the implications around the globe. But sectorally, Sanjeev, which sector looks the most vulnerable to you right now? Because for pharma, we are waiting for fresh tariffs announcement. Other than that, IT is one of those globally linked sectors which is getting hammered. And what we are seeing in electronics, there is some bit of an opportunity also lying in for the Indian players. But give us your sense that sectorally, how do you see the picture playing?
There are three, four sectors which are most impacted around uncertainty. One is, of course, autos. Second is chemicals, IT, and then pharma, of course. Now on chemicals, it looks like a lot of chemicals have been exempted from tariffs initially. Almost 70% of imports by the US by value have been exempted for now. Now, whether that is permanent or things will change, only time will tell. Assume some sort of tariffs will eventually be there on all sorts of imports, which the US does, because the stated objective again is, to have a much stronger chemical manufacturing base in the US. That's one. Pharmaceuticals, I assume in the near future you will see some announcement. It will take some time, for all the investigation which the US has started to complete. Could be 2, 3 months down the line. Will probably coincide with the end of this whole 3 month reprieve period, which has been given in a way. But you still have a lot of uncertainty out there. Thankfully, for pharmaceutical, it does not look that impact is that significant. And we have done math company by company in terms of what is the EBITDA or PAT impact for a 25% tariff regime. For some of the companies, it looks quite manageable. Of course, the domestic companies like a Mankind, Torrent, obviously, don't have much to do with the US anyway, so they are quite fine. And for the CDMO, CRDMO companies, the good news is, I would assume the US would ultimately want to diversify its, sourcing base. And given the fact that India's market share is still very small, hopefully over a period of time that can increase. Of course, in the interim, tariffs will hurt, but I assume it's applicable for just about every company at the same time. On IT services, the issue is not so much a tariff, but the whole uncertainty being created, in several sectors, starting with financials, manufacturing, retailing. Companies are obviously not in a position to take any major investment decision for now. So a lot of the discretionary spending related to IT will probably get pushed out, maybe to the second half of the current calendar year, which would obviously affect FY 2025, FY 2026 revenue and EPS numbers. Yeah. On autos, as of now, we still have the tariffs. There is some hope that this will also be removed. So let's see, what happens over there. But given the fact that the US has been giving some concessions on other segments, it's probably not surprising that, probably we'll see some reprieve on the auto sector also. But, the broader point here is if you leave aside chemicals and pharma, which are slightly more immune to, demand slowdown, ultimately both autos and IT services will get impacted by a slowdown in the US and other markets, for sure. I mean, you're not talking about recession, it's like that, but, these are discretionary items, whether it is household or a company, and the consumption of or investment on these items can be pushed out. In a period of uncertainty, I suspect both are going to happen.
Sanjeev, I'll use TCS as an example, just to illustrate a point for our viewers. The stock did not fall after the numbers, even though there was nothing great or glamorous about their guidance. Could that be the case for IT, that everyone knows the bad news, whether it is AI or whether it is, impact on the BFSI space? After all, Sanjeev, these companies still have cash. They still do buybacks. So could that really act as a backstop for IT now?
That is on an as-is basis now. So, the worst case situation which the market is looking at when TCS or before TCS reported was a complete, meltdown in the global economy. You had the US bond market, which was looking extremely shaky. Bond yields had spiked significantly. There were concerns around recession in the US. Even now, there is talk about 30-50% chance of recession in the US, right? So in that case, obviously, there were a lot of concerns which had got priced in. Why it has not fallen is, since then you have had some positive news with respect to the reciprocal tariff issue and sector tariffs, being removed for the time being. So all that is helping sentiment for sure. But if you look at the the valuations of a TCS or for that matter any IT company or for that matter any company in India, in most cases, the valuations are significantly higher than the pre-pandemic levels. And this is where I keep beating my head, in a situation where short-term growth is definitely weaker compared to whatever this company delivering before the pandemic. And medium-term issues are also, looking a bit shaky given a lot of disruption which is taking place across every sector. And global bond yields are higher. How do you make a case for higher valuation now compared to the pre-pandemic levels? So in all parameters, things are looking worse and multiples are higher, which is a central point, when it comes to the market. We just struggle to get our head around this very basic fact. How do you pay for higher multiples at a time when growth is lower and risks are far higher?
So let's look at the other side where the movement has been quite sharp, decline in commodity. So at what point in time the realization in the market would come in that, okay, go back to commodity, consumers. For example, cement has suddenly started doing well because coke prices and raw material prices have come down. Is it time to perhaps look at commodity consumers now, wire companies, cement company, that entire supply chain?
Ultimately, these are commodity and competitive businesses. So to make the assumption that the bulk of the benefits of lower raw material prices will be captured by the companies may be a bit too much. From time to time that will work out, but historically we have seen, it's hard to retain these benefits. And remember, cement, the capacity should be 70%. More than that actually. And in the next 2-3 years, we're not seeing any major improvement over there. At the same time, our basic assumption is cement demand will slow down this year, given the slowdown on the investment side, but you link to the government capex, which we can discuss separately. If you look at the cable and wire business, you have a lot of exports to the US, by the way, also, yeah. So that will definitely struggle given this whole tariff issue. And obviously, the tax is not going to be as low as what we have been before this whole tariff saga started. Whatever the number may be, it will definitely be higher than whatever it was in the past. And we are seeing a global slowdown. And on top of that, you are seeing more capacity being added in India, more in this backdrop. And the multiple not cheap for any of these companies, by the way. I have always struggled, how does the investment community in India give 35p for a cement company? I think it's something which I need to learn from them anyway.
All right, Sanjeev, but other than equities, what's been happening within the bond market and the currency market? I'm sure that you must be tracking that very closely, but give us some sense that do you believe that with a short-term bounce in the equities, what we are not just seeing in India, but the globe across, the next big headline could be coming in from the bond and the currency world, and that is what you're tracking very closely right now?
Things have come down as far as the bond market is concerned. Calm down within reports, obviously. I would say you just need, one more bad news, for things to get, wobbly once again. The US Fed has made some statements, about providing support to the bond market in case, things worsen. But, there are a lot of reasons why we have seen what we have seen in the bond market, a lot of, unwinding of leverage positions, hedge funds, taking very aggressive bets on using treasuries as a collateral, a lot of money being raised on the back of that, margin calls being there. So that has resulted in a lot of, shakiness in the bond market. So for the time being, things have calmed down. But, you're also looking at, odd situation of possibly higher inflation linked to, tariffs, which are anyway in place now. Remember the 10% tariff and higher tariffs in some other sectors is already in place. So clearly prices will move up as we go along. And you're looking at a situation where global growth is slowing down, US growth is slowing down. So you have a situation where you are struggling on the one side with lower growth and on the other side with higher inflation. So what does the US Fed do in that case? Priority, I assume, would be on managing inflation and make sure that inflation expectations don't get unhinged. And so let's see, it's all very, very fluid, I would say. Even if you look at the currency market, similar situation, the US market does well, US dollar rallies, US market doesn't do well, other currency rallies. So it's all, up in the air for now.
All right, Sanjeev Prasad, thank you very much. Thank you for joining us.
If you like this video, then like, share and subscribe to ET Now.